Welcome back. Today's presentation is going to cover the numerous advantages to using the APAMI indicator, mainly to determine trend direction and to create a positive expectancy so that if you use it as a signal, you can make your trades more profitable. The advantages include clarity, simplicity, zero lag guarantee, uniformity or consistency, and scalability, being able to put it on multiple charts, and also the ability to build complete trading systems, particularly mechanical trading systems. So first, let's talk about clarity. Typically, new traders and even many more experienced traders will attempt to guess and predict what the market is going to do. And in doing so, they come across a variety of technical indicators that they think will assist them in accurately predicting the market. So how they do this is they'll start out with one or two indicators, see how it looks on a chart, looks kind of cool. So then they'll start adding some more indicators in this big attempt to try and predict exactly what direction the market's going in. So the final result is what's known as indicator overload, where there's just so many indicators on a particular chart that you really just don't know what to do anymore. So if the choice is confusion or clarity, I think the clear winner is the APAMI indicator in terms of being able to readily identify uptrends and downtrends. So now we'll cover simplicity. APAMI measures the distance between 2 points tick by tick. Think of APAMI as kind of like a ruler, but instead of measuring objects using inches or centimeters, we're using units of pips or price points. If you've ever driven a car or motorbike, you will see an odometer, which can be used to measure the total distance traveled on each road trip. Well, in a similar fashion, imagine that the APAMI indicator is like a trendometer that measures coincident price action across ticks. This brings us to our third advantage, which is the zero lag guarantee. APAMI is a coincident indicator. This means it calculates the direction and length of all trends as they occur in real time. There is absolutely no averaging of past data, nor are there any predictions about future activity. So it is actually impossible for the indicator to lag or quasi-lead current price action. All APAMI does is just measure price in real time. So the trader has the ability to focus only on what price is doing in the present moment, or right now. So now let's talk about uniformity or consistency. I've observed that there's a popular belief going around in Forex trading forums that multi-time frame analysis somehow increases the accuracy of lagging indicators. Even if you use no indicators at all, the idea that something unique is on a different time frame. Well, I have some bad news for you. Lag plus lag equals even more lag. The previous models that are based on time shift or multiple time frame analysis have been pretty much made obsolete now that APAMI is on the scene, simply because they're based on predicting what the market will do, whereas APAMI is showing you exactly what the market is doing now. A 60 pip price move on a 15-minute chart is still 60 pips on a 4-hour chart. The specific type of chart has absolutely no bearing on how the price action actually moves. It's just the way that the prices are presented. In fact, you could remove the price bars, whether they be candlesticks, line, Renko, 3-line break. You can remove the price bars from the chart and just trade strictly off tick data. The type of consistency in the way that the calculations are performed in APAMI is absolutely critical when building mechanical trading systems, which we'll get into in a little bit. So now let's talk about scalability, being able to put APAMI on multiple charts. APAMI tends to be light on resources. It uses only a modest amount of RAM and CPU processing power. So it can be placed on any time frame, any chart, and measure any reasonable length trend. You could even measure different distances on the same currency pair.
For example, you can measure longer term trends like 150 or 200 pips in one setting, and in a different setting you can measure like 30 pips, 40 pips. And the final advantage that we will talk about today is scalability in building trading systems. With a uniform method to measure price trends, the next logical step would be to create a system of entries and exits. I mean, it's one thing to be able to measure price trends, but it's a whole nother thing when you can take those price trends now and turn it into a complete system where you can potentially make profits over and over again. Now, there's no right or wrong way to set up a system, except you must make sure that the system can produce results consistently over and over again. The best way to show this is to simply watch a complete system in action. You can already see the move has already completed in the up direction, so we have an up move, and then we start placing trades in a grid formation and then wait for a profit target to occur. The equity take profit was in fact hit, and we did remove all the trades off the table. And then we start all over again, looking for the next up or down trend to take advantage of. So we have detected a downtrend, and we can see the market moving down further. We have placed some grid trades to go long. And then we'll offset when a net profit has been reached. There are many more advantages, too much to list. So the best thing for you to do is simply download the indicator, put it up on a couple of charts, and just see for yourself all the possibilities. Thanks for watching, and we'll see you on the next video.